Warming up the hands. All right, good Thursday afternoon, investors and traders. Welcome to Finom Group's weekly State of the Market. I'm your host, Seth Golden. And as you can see, and maybe have felt over the last few trading days, the question is, are we in the midst of a taper tantrum? Second one in history, right? Because really we only have one sample size. 2013, May 2013 was when Ben Bernanke delivered his testimony before Congress and outlined the tapering plans for the Fed's balance sheet and just general asset purchase activity going forward. Well, based on yesterday's FOMC minutes that were released, it looks like, the plans for tapering, the messaging of the plans may come sooner than many folks have anticipated. They may come as early as the September meeting. And tapering itself may actually start before the end of the year. Many strategists, just general market participants, have been anticipating actual tapering not until January of next year. So the market's throwing a little bit of a hissy fit here this week. It is monthly options expiration, triple witching here this week. We've anticipated volatility expanding into monthly options expiration, along with just this general seasonality that happens in the month of August into September. So taper tantrum 2, we'll find out. I mean, the market has pulled back a good 2+% from its all-time high of 44.80 coming into this week. And it's all about being prepared. It's all about having a game plan. It's all about anticipating the next move in the market, right? Everybody's trying to get out in front, trying to beat the market, trying to outsmart the market. Don't do that. Just have a game plan that works with the market, ebbs and flows. Something that we talked about in our weekly research report right here, this beautiful graphic. They say that trading hierarchy is 10% technical analysis, 30% risk management, 60% patience and emotion management. So the majority of what you're doing as an active portfolio manager and market participant is managing your emotions. Like if it took IQ, more people would be studying. But when it comes down to it, investing and trading is it's mostly about managing your emotions. Your emotional quotient needs to be greater than your intellectual quotient, if you will. Unfortunately, you can be the smartest person in the world and still be a horrible trader, right? When we think about hedge funds, they're supposed to be the smart money, right? Not so much. So just kind of digging a little bit deeper in terms of that emotional quotient and, your investing edge. There's 3 sustainable edges in investing. Which one are you employing? So let's look at the 3. And the key word here is sustainable. This actually is something that was contemplated by, he used to work for Baird, Michael Antonelli. And he says, number 1, be smarter than everyone else, right? If you are smarter than everybody else, you've got some kind of intellectual edge. Number 2, be luckier than everyone else. A little bit of luck doesn't hurt. Number 3, be more patient than everyone else. Just remember, when you think about these 3, smarter, luckier, more patient, these need to be sustainable for you to have an edge as an investor or trader. Most of your hedge funds, clearly, based on their performance historically, don't hold any of these edges. If we look just at this year, this is the Goldman Sachs Hedge Industry VIP ETF, juxtaposed with the S&P 500. The S&P 500, atop, going higher, more than almost a 20% gain year to date. Of course, that's not counting this week's pullback. But look at the hedge fund ETF, a little bit over 11% return year to date. And there's the gap, about an 11% gap in performance. Hedge funds are not the smart money many think them to be. The Goldman Sachs Hedge Fund Industry VIP ETF identifies their underperformance, folks, when compared to that of the S&P 500. This is not even out of the ordinary. Go as far back as you want. Most hedge funds underperform the benchmark S&P 500. Revisiting some themes from the past, of course, here we are, still without our 5% correction. Again, I said, we've drawn down 2% from the all-time high. We still don't have a 5% pullback. We can't really call it a correction. That's not a textbook definition. A textbook definition for a correction is at least a 10% pullback on a closing basis. We haven't had a 5% pullback on a closing basis, although we have dropped peak from trough on an intraday 5.8% earlier this year. So we're now at 200 days. And when you look at this chart of the times that this has happened in the past, number of market days prior to the start of a 5% correction right here in this panel, we've had other streaks, other long streaks without a 5% correction. But notice where they show up. They show up in the green. They show up in the green. They show up in the green. What does that mean? These are secular bull markets. Usually during secular bull markets, you can have streaks without protracted corrections. So I thought that was an interesting feature within this chart dissemination by Ned Davis Research. Good on them. So taper tantrum, one of the qualifiers, part of the Fed's mantra over the duration of this post-pandemic period, in order for them to feel that it's appropriate to taper, it's appropriate to remove some of the liquidity provisions that they've provided since April of last year, was substantial further progress on their dual mandate. Now, the one aspect of the dual mandate being price stability, i.e. inflation, core inflation, above 2% now, that's been satisfied. Like, we're there. We've been there probably for the last 5-6 months now, well above their inflation mandate. The other component, however, is maximum employment. And on the maximum employment mandate, that one's been a slower progression, although it has indeed progressed. It's hard to deny, though, the trend. The unemployment rate percentage has been falling since February of 2020. Black unemployment rate, employment to population ratio. And when you just look at the last two non-farm payroll reports, and you include the revisions from the previous, you've had about 1 million jobs for each non-farm payroll report going back the last 2 months, if you include the revisions. I would be of the opinion we've made substantial further progress. We may need more information for the month of August. We won't get the non-farm payroll report for the month of August until September. And that still could delay messaging on tapering. Again, right now, based on the FOMC meeting notes that were released yesterday, there are more FOMC voting committee members that think it's appropriate to message the plans for tapering and possibly begin the tapering process before the end of the year. I think they still want to see what the August non-farm payroll report looks like before they move forward. Again, there's a September FOMC meeting. They will have the August non-farm payroll report before that FOMC meeting, kind of coming together pretty well for them. I think at this point, from an investor standpoint, an active portfolio manager, you have to just have it in your head, they will announce the plans in September. Not saying they will, but just put that kind of expectation forward. Have that front of mind at this point. Investing is about managing emotions. If you hold that expectation that they're going to message in the September meeting and they don't, guess what? You're no worse for wears. You're not panicking, and you have a little more time probably for this market to grind higher, possibly get back up or to 4,500. but managing emotions, setting appropriate expectations, thinking ahead. What's the next move? Here's the Bank of America. This is their kind of a roadmap, if you will, for the Fed tapering. Expected taper trajectory. We anticipate the Fed will begin tapering in November in a proportional manner at each meeting across U.S. Treasuries and mortgage-backed securities. So they believe they'll start tapering November, U.S. Treasury amount, mortgage-backed security amount. These are just projections. These are not the Fed is going to's. They're projections. And right now, we are still in the state of speculation when it comes to will the Fed, won't the Fed, and when the Fed, and by how much will the Fed taper. It's still all speculation. Our job, again, is just to have, appropriate expectations going forward. One of the tricks that I've used over the years is expect worse. If you expect worse and you get above that, if you get better than worse, again, you're no worse for wears. Thinking of the S&P 500, now that we're starting to pull back once again, we're looking at breadth on a daily and weekly basis inside the Finom Group weekly research report, on a daily basis inside the Finom Group trading room. What we are recognizing here with this chart from Andrew Thrasher of Thrasher Analytics, Finom Group has been assessing the correction taking place underneath the hood of the S&P 500. How many times have we said that, right? We've already had a correction. We're in a correction. We've been in a correction. With the index down less than about 2% as of yesterday's close, 10% of the S&P 500 stocks are down like 20%. As you can see here, 10% of the S&P 500 is down already 20%. They're in bear markets. Almost 35% of S&P 500 stocks are down 10%. They're in full-on correction territory. And that number has been, rising. So has the number of stocks in bear market territory. Like, the correction has been here, folks. It's not the S&P 500's fault. It's not the Nasdaq's fault that they are cap-weighted indices. The large cap growth names have held them up. But we've had a correction. We've been in a correction. Other breadth metrics that we've been identifying lately, just kind of in terms of, yesterday was a rough day in the market, S&P 500 down 1%. The Nasdaq down 0.8%. The market's overall down for the week. Is this going to lead to something bigger? In my opinion, it can. The probability is lower because of what we just mentioned here. And, while we look at the New York Stock Exchange New Lows index, right? And that's been moving higher also, right? If more stocks are, traveling away from their, 52-week high, then, we should expect more stocks to be hitting their new lows. But even with the S&P 500, Nasdaq, Dow, NYSE down yesterday, fewer stocks were actually hitting new lows. It was really weird. You don't expect to see that. Is that the signal of a bottom? Let's move on and find out. The Nasdaq 100 stocks above the 50-day moving average. And why are we looking at the Nasdaq 100 instead of the Nasdaq? Well, because the Nasdaq 100 are those cap-weighted stocks. They're the growth stocks, the mega cap tech names, and so forth. Your consumer communication service names like Google, Facebook. That's what's going to move the Nasdaq. So the Nasdaq 100 is going to move the Nasdaq. So when we look at the stocks trading above their 50-day moving average and in this particular index, we see how weak it has become. It's all the way down to 57% coming into today's trading session. That is the lowest it's been since here in mid-June. What that tells us is finally they've been able to hit some of the larger cap names, right? Think of Tesla this week, Google, Amazon this week dropping below 3,200 in the pre-market this morning after earnings or since earnings. Apple's pulled back to 146 from 150 plus, right? They've finally been able to hit these large cap names. So you have the weakest breath that we've seen since June in the Nasdaq 100. I hearken back to, do these names to be, my question, do these names deserve to be sold off that much more? Well, if tapering, okay, good point, right? So we go back to 2013 and the S&P 500 had a peak to trough 6% correction over the course of about a month, give or take, a week or so. We're already down 2%. How much further can we possibly go down? And how long will it take? Will it take a month like in 2013? Remember, the liquidity paradigm that this market is in compared to 2013 is miles apart. We had ample equity market liquidity in 2013. We are operating in an equity market liquidity paradigm that is the worst it has ever been, basically. The worst. It's at the lowest levels in history. It's been drained. That liquidity of the equity market has been drained since 2016. You wonder why we've had V-shaped recoveries? So you don't tend to get V-shaped recoveries when you have a whole lot of liquidity. But when you do have very low liquidity regimes, it's a fast move to the downside and it's a fast move back up. So again, this got worse. This got worse. They finally came and hit the large cap names. And another reason why we don't look at the Nasdaq percent of stocks trading above their 50-day moving average, which is still right around 25, 30%. It's awful. But there is so much garbage in the Nasdaq once you drop below the Nasdaq 100. There is so much garbage. Non-profitable tech stocks. They might as well be small caps. And that's what this chart basically shows you. This is the Nasdaq 100 in blue versus the Nasdaq non-profitable tech names. And you can see those non-profitable tech names peaked here in February. It's been downhill mostly since, while the Nasdaq 100 has done a good job of making new highs. Nasdaq non-profitables are now lower on a year-to-date basis return than the Nasdaq 100. But again, just kind of highlighting, there's so much junk in the Nasdaq, which is why it's a better gauge of the index forward return probabilities or declines when you look at the Nasdaq 100. So much garbage, non-profitable tech in the Nasdaq itself. All right, we looked at the New York Stock Exchange new lows. Let's look at the Nasdaq new lows then. And you can see the same thing. The Nasdaq was down on it like 0.8%, 0.9% yesterday, but look what happened with the new lows. It dropped off a cliff there. We had gotten to levels that also suggest we should be bottoming in the Nasdaq. Have we bottomed? Again, all part of the weight of the evidence approach that we use in studying the market internals. But weird, right? Again, looking at these different breadth metrics, and with the markets declining on average 1% yesterday, you would expect a lot more new lows, not fewer. All the breadth metrics we've looked at show a greater correction has been taking place for a few months now. Such a correction could broaden to the large cap growth names, but beneath the surface, correction may actually prove the support for markets if or when taper tantrum concerns materialize for the large cap growth names. So maybe we do get a taper tantrum and the indexes go down, but underneath the surface, like those stocks that were already in correction, already down 10 and 20%, maybe those are the ones that are going to get bought, while the large cap names, pass the leadership baton again. And if the large cap names pass the leadership baton, markets can go down, the indexes can go down, but underneath the surface, breadth is probably going to improve. Like, this cyclical bull market is not your grandfather's bull market, folks. And in terms of, looking at drawdowns, based on cap level, you can see large caps have done well. When you go down the cap level scale, mid caps, you can see it gets worse and worse. The drawdowns are bigger and bigger. How defensive are people? Anticipating that taper tantrum, anticipating just, a bigger correction in the S&P 500. Again, turn on any financial media news network. It's all they talk about. It's like 24/7. They need their own network. The pullback channel, the correction, the next bear market channel. They need their own channel at this point. It just litters the airwaves. But investors have been defensive. They have been preparing, if you will. We can see that in the relative performance ratio of consumer staples and utilities, which are defensive areas of the market, versus the S&P 500. And you can see they've rallied here in August for consumer staples versus the S&P 500, an even bigger rally in utilities versus the S&P 500. They are positioned defensively. Investors have been, looking at even under leveraged areas of the market. This may look like, a bearish posturing from investors. That is one way to look at these performance ratios, right? The other way I would look at it is look at the long-term chart. Look at it from, this side of the chart down to here, this side of the chart down to here. What's the big picture takeaway from this defensive positioning, this posture amongst investors? In my opinion, the big picture takeaway is this cannot persist. And in fact, it has no probability of persisting unless we're going into a bear market. And so there again, you have the question, do you think we're going into a bear market? What are earnings doing? What is, the economic outlook appear to be? What are credit markets doing? Are we going to have a bear market in back-to-back years? Really? So again, either, you look at this from an optimist point of view and you say to yourself, this has no probability of persisting, this defensive positioning, and we might even be at a peak in defensive positioning. Or do you think we're, being a pessimist? Are we going into a bear market? I'll let you decide. What's the weight of the evidence tell you? Another chart right here. In terms of looking, again, breadth is not all informing. Market breadth is actually less reliable indicator of tops than it is of bottoms. Therefore, it holds less utility for investors when breadth is strong. When breadth is strong, there's really not a whole lot you can do. It's hard to buy strong breadth. As markets trend higher, and easier to buy weakness. So there's not a whole lot of utility in identifying that breadth is strong. But when breadth gets weak, you can almost pinpoint washout opportunities where you should be layering in. You should be buying the dip. Waning participation characterizes aging bull markets, but is not a direct sell signal. The matter is actually best summarized by Bob Farrell's rule number 7. Bull markets are strongest when they are broad and weakest when they're narrow to a handful of blue chips. The term weakest, however, because that needs context in my opinion, the term weakest means vulnerable. So some of the breadth metrics that we noted before and have talked about in our trading room on a daily basis, it's not a matter of really of, are we going to get a 10% correction, a 5% correction? Are we going into a bear market? It's a matter of when breadth weakens, it just makes the index that much more vulnerable to some kind of exogenous shock, a headline, so on and so forth. That's it. It's a matter of the index being vulnerable. Despite limitations, breadth analysis, though, is important. It's good to know when a bull market is vulnerable. Let's put it that way. Be careful just not to overanalyze, however. Breadth erosion it's an inconsistent process. It happens here and there, but to suggest you can time breadth weakness, forget about it. Just follow the breadth. Don't try to time it any more than you would the market itself. So again, we talked about defensive positioning. Here also in the equity put call ratio, and again, I'm going to go back to that word weird. Yesterday, the markets dropped 1%, and yet the equity put call ratio dropped, from 0.58 to 0.52. Still elevated for this particular regime, and it has been rising since June, as you can see. But a 1% drop at the index level and the equity put call falls? Again, a little weird. Either one of two things is happening here. Either premiums are just too rich at this point for hedging, and or we're in a bottoming process. And when you put all of these variables together that we've discussed, the defensive positioning may be peaking, the new lows at the highest level we've seen since March for the Nasdaq. The Nasdaq 100% of stocks above their 50-day moving average moving to their lowest level since June. New lows in the NYSE at their highest level since May. These actually, when you combine all of these different breadth metrics and hedging options and defensive positioning amongst market participants, you put it all together, it does feel like a bottoming process. Where the ultimate bottom in this particular pullback will be remains to be seen. We're trying to put the pieces together during the trading week to extrapolate, the probabilities going forward. We've had a double in the S&P 500 since the March low. It's amazing. Usually it is about this time. We go back to 2008, 2009, we doubled by, it looks like mid 2011, and we had a pretty serious correction. Here again, from 2011 up to 2015, and then we had another nice correction, so on, and here we have doubled again. Markets don't always repeat, but they often rhyme. And the catalyst for this could be, for a deeper correction, indeed, could be the taper tantrum. Weight of the evidence, folks. Now, the S&P 500 is down 3 days in a row. It's about 2% lower, coming into today's trading session. And as we've looked at before, the percent of stocks trading 20% off their highs, percent of stocks trading 10% off their highs or greater. The average stock in the S&P 500, the average stock is 9.4% below its 52-week high. 9.4% below, and that's been, decreasing actually. We've been in a correction. Most stocks, the average S&P 500 stock is 9.4% off of its 52-week high. We have been in a correction. All right, now coming into this week, something that we highlighted on our weekly research report. And to the benefit of the broader community, maybe this is your first engagement with Finom Group, this may prove quite eye-opening. a lot of the studies, a lot of the quant data, we are capturing from third parties. It's easy to achieve the information. It's what you do with the information that matters most. There's additional analysis that needs to develop when you're reading, something, when you're reading a quantitative study, when you're reading economic data points of interest, when you're reading a chart. There's developing analysis that needs to go along with that. Otherwise, there's no utility in what you're doing. There's just not. One of the things that we do here at Finom Group is we're taking that information from all walks of the market world. We're logging it, we're cataloging it, if you will, and we're analyzing it on an ongoing basis. Why? Because the market is ever churning. So this particular one came to us about a month ago. Actually, it was a month ago, July 21st. And we issued it in our weekly research report. It has actually developed from sentiment trader Jason Getfert. So let's read it for you. The up volume ratio cycled from below 15 to above 85 in back-to-back sessions on the NYSE. This triggered last June. This also happened here last June, and it marked the end of that little pullback, kicking off an impressive run over the next few months. That was much more the rule than the exception. Like, that was supposed to happen. Market was supposed to move higher after you cycled below 15% up volume ratio on the NYSE to 85% up volume. Why is this so important? Well, it happened again here on July 21st. From down 15%, from up volume only being 15% to 85%. Since 1962, the S&P 500 never showed a loss in the month following similar signals, according to Sentiment Trader. That's some seriously powerful quantitative data, folks. Indeed, from July 21st, we traveled up to 4480 on the S&P 500. Where was the market on July 21st? On July 21st, the market closed 4358. Remember, since 1962, the S&P 500 never showed a loss in the month following similar signals. Today is the 19th. In order for this to remain perfect, the market cannot close below 4358 after it has fired this signal. So the market has pulled back from 4480. In the pre-market today, Thursday, August 19th, with only one trading day left tomorrow. So the market has to hold above 4358 on a closing basis tomorrow in order for this study to remain perfect. Guess where S&P 500 futures based this morning when the majority of brokerages opened at 7 o'clock a.m. Eastern Standard Time? That's right, 4358. That's the benefit of this type of analysis. Again, this article was issued by Sentiment Trader back on July 21st. How many people do you think are still attuned to the message of perfection in this breath signal? Hopefully a lot, because I reminded them. In fact, this weekend, I was doing this analysis as part of our Finom Group weekly research report, and I think it was on Sunday. I tweeted out, time to piss off the bears. As always, history doesn't always repeat, but it often rhymes. This is triple witching options expiration week ahead, and if it finds volatility expanding with the S&P 500 retreating, The lowest it can likely go is 43.58 based on Finom Group's calculus data. Repeat or rhyme. We will find out by 8/21. Naturally, tomorrow's the last trading day of the week, so it has to be tomorrow, the 20th. But again, how many people do you think even remotely remember this study from Sentiment Trader that was delivered on the 21st? Let's take a quick peek and see where the market is here intraday, folks. We are up 15 points on the S&P 500 at the moment. Nasdaq is the clear leader on the day, and the Dow is just about to go positive after opening up down 200 plus points. Remember, in the pre-market futures for the S&P 500, 43.58. Why is this information so relevant? You and I are not the only ones that see this information. This information, what do you think codes, algorithms? What do you think drives the market? More than 80% of volume is algorithmically generated in today's market. That's the kind of information that they use to code their algorithms. Oh, I want earnings to matter. I want economic activity to matter. Algorithms overpower. But this is the kind of data you need to stay in touch with. And this is what we deliver. And there's so much more, folks. Our Finom Group members, you know that. But to the extent that we regurgitate and reiterate and review this, and it makes our weekly research reports go like this, there's a point to it all. All right, let's fast forward. Should I buy the dip? What do our dip buying indicators tell us? Well, one of our main dip buying indicators is credit spreads. Are credit spreads blowing out? No? Okay, good. Buy the dip. They have been widening a bit. Not going to lie. They have been widening, but that's just enough to cause or give credence to a normal and expected pullback. It's nothing ominous. Fears over Delta. Should I buy? Is the economy actually weakening? And you've heard the message from the retail sales report. You've been listening to the CNBC saying that the weakness and, well, consumers and Delta, they're probably nervous, blah, blah, blah. When we look at the components, the categories, we fell on a month-over-month basis, because that's the headline that's delivered from the Census Bureau. Retail sales fell from June to July 1.1%. But on a year-over-year basis, we're still up almost 16%. What's weak about that? Shut the front door of your mouth. Where the biggest decline came from was autos. Why do you think autos are suffering at this time? And yet they still grew, mid-teens on a year-over-year basis. But from the high comp last month, guess what there is now? Less and less inventory. What did we hear from Toyota this morning? Toyota is cutting production because of they have less supply, right? The chip shortage, materials, supply bottlenecks. This is not a demand issue. This is a supply issue. People are so scared of Delta. That's why they're going out to food services and drinking places, i.e. restaurants. That grew 1.7 month over month. It's one of the few without a negative, sign right there. And it grew 38% year over year. Really? Scared of Delta, but they're going out to restaurants in an increasing fashion. Air travel, 100%. We've seen definitely an impact on air travel. I mean, that is as confined a space as you can possibly get without, the benefit of knowing the person next to you. And look at Delta cases. We're plateauing in these most heavily, these are the states with the highest recorded infection rates, but they're almost all plateauing, except for maybe Maine. Missouri's rolled over. I mean, they're mostly plateauing, and it looks like we're plateauing on the United States. This is the CDC's data. And look at Florida. The highest number we had was 21,783. We haven't been above that level in 2 weeks, in 3 days now. It looks like we're plateauing. Air travel, like I said, yeah, I get it. But look at restaurant spending. It's pretty steady, folks. This is about Delta. That's what CNBC's saying. You know, the slowdown in retail sales is about Delta. People are a little bit scared. Not enough stimulus. Really? People aren't getting checks? And here's the motor vehicle sales. You can look at production and again, it's going to get worse because Toyota just said they're going to cut production. The demand is there. Look at sales. But sales can't, eventually you find that both the demand will suffer because there's not supply. And people can't buy cars, guess what else? They're going to divert the spending somewhere else. Nothing that we see in the data says this is Delta-driven weakness in the month-over-month retail sales, which again, still grew 16% year over year just about. Nothing is telling us that this is Delta-related. I mean, Costco's trying to take advantage. Microchips and other material automakers used to build their vehicles are scarce this year, impacting inventory levels at dealerships nationwide. The impact of these shortages vary by dealership. Costco's auto program is closely monitoring the situation by manufacturer. Here's what's going on, folks. This has nothing to do with Delta. It really is about the child care tax credits. It's causing a timing issue. We got the first rollout, the average household who qualified for the child care tax credits, they got their first check mid-June. Look at the ramp from the first week of June into that mid-June, receiving of the check and through the end of the month. Well, guess what? They spent the check, and now you have a lull from the first week of July until you get that next check mid-July. And people are going to get the next check mid-August. So you get another ramp up. Again, where's Delta? Well, I'm sorry, but actually July retail sales ramped ever since the first week into the first week of August. And guess what's happening? Once that check is gone, we come back down. We're getting the check again. It wouldn't surprise me if we started to ramp once again. This is not about Delta. It's about when the average household gets that child care tax credit. Because when they get it, man alive, do they spend it. This is from Bank of America's total card spending. Households that receive the child care tax credit in dark, look at that, just boom. Households that did not, they're not spending as much. This is not about Delta. That's what the media will promote, right? They don't have the time to do this. I get that. That's what we're here for. This is the heavy lifting that we do as investors, analysts, portfolio managers. And so what's the other thing? Oh, copper, Dr. Copper, right? Copper not doing bullish things here. This is Willie Delwich of allstarcharts.com. Copper fell to a 4-month low in today's session around 412. It fell below 4 today. It's since bounced, but it fell below 4 today. Price was in a strong uptrend between March of 2020 and May of this year, surging more than 100% in that time. However, began breaking down in June, and it has continued to trend lower ever since. Due to the metal's numerous industrial uses, copper often acts as a leading indicator for global economic growth. Remember, one of our buy the dip indicators is related to economic growth. Is the economy expanding or is it going into contraction? And the stock market, of course, this is just one data point to consider, but seeing copper hit fresh 4-month lows like this doesn't exactly inspire confidence in the bull case, right? Retail sales, Dr. Copper. The reality is this is supposed to happen. How do we know? This is a study that we delivered in mid-May. The S&P 500 after stocks and copper are up at least 7.5% year to date. And in May, the S&P 500 was up 10% and copper was up 30%. I mean, a huge run in copper. What happens after? Well, here's what happens. It's happened 8 times since 1950, okay? Both the S&P 500 and Dr. Copper are up at least 7.5% by May. It happens 8 times since that's not a big sample size, folks. This is rare. What happens to the S&P 500? The average return, it muddles over the next month. 3 months later, the rest of the year, typically higher 7.5%. But look at what happens to copper. Average return, down 1 month later, down 3 months later, down the rest of the year on average 16%. How many times out of this 8 occurrences has it actually been up? Once, or 12.5% of the time. Only one time was Dr. Copper up the rest of the year. What this study tells us is this isn't really Dr. Copper telling us anything about the economy. This is a reflation period where commodity prices will normalize. That's all Dr. Copper is doing. If historically this was an indicator, a leading indicator for the economy coming out of a recession, wouldn't the S&P 500 be down the rest of the year also? The S&P 500 was only down once out of these 8 occurrences. There's nothing in the economic data that tells us we have a problem. Last thing I want to remind us of, the economy is not the market and the market is not the economy. That's what this bar chart basically tells you. It breaks down all the different sectors of the economy versus the S&P 500. This is the S&P 500 technology sector ETF. This is technology in the economy. It's nothing. The economy is not the market. With that being said, that's our weekly state of the market. We'll see, whether or not this market has a bigger taper tantrum or not. To receive our weekly state of the market in real time every Thursday, please subscribe to phenomgroup.com. Otherwise, you'll have to catch it over the weekend. Have a great trading day, folks.